Hey, what's going on, everybody? Andy Nash with the Fish Hook Trader here. So, a couple things I want to touch base on real quick. One thing I've noticed on, seemingly a lot of people's comments. I like to read comments on all these advertisements that always get fed to you, when you start, clicking on a bunch of different websites and looking into different things and stuff like that. So, I click on some comments, with some of these ads that are talking about options trading, because that's what I specialize in overall. And so what I want to talk about is some comments that I read, when I look through there. And it has to be 80% of the people that I see commenting are like, oh, that's a good way to lose all your money. Or, oh, yeah, put in $1 million and walk away with 1,000, and it makes me laugh because it's like, well, most likely these people either had no idea what they were doing, or they have never traded options, or they knew somebody who did and did very poorly at it, thus making their conclusion what it was. A couple things I want to talk about. First of all, I want to let you know that up until March, so I'm doing the annual, you can pay monthly or you can pay one time, for the whole year. It's going to be an email newsletter. It's going to be active learning. You can communicate with me anytime through the email, thefishhooktrader@outlook.com. You can send payment to PayPal at footballman24@hotmail.com or the Cash App, money sign NeuroNash24. So you can send it that way. So payment is only $40 right now for the whole year up until March. And after that, it goes back to normally $80. Or you can pay monthly, set it up as a monthly pay, to the Fish Hook Trader. And it's going to be $10 a month. So $120 for the year. Or, like I said, one time $80. Or right now, up until March, $40 for the whole year. And I'm going to teach you a lot more. Sorry about the camera here. I'm going to teach you a lot more than some of these other folks that are, peddling stuff that's, it may work for them, et cetera, but they're charging you, like all these ones I click on just out of curiosity, trying to find my pricing, for folks that want to learn. And we're talking like, oh, it's on sale for $1,500, for this class and these lessons, et cetera. And it makes me really curious on, are people really paying that much money? Because I watch some of these free videos that they do. And I've done plenty of free videos here, on YouTube. This will be on YouTube and Instagram. And it makes me curious that people pay so much money, including myself. I paid for a stock market class, and I paid well over, normal price was $25,000. Seriously. And I did not go to some big show thing that was in Vegas that was included in the package, so that shaved off a nice chunk of money. And so I ended up paying a little over $12,000, $14,000 in total if you count the previous class payment. So it's a 2-year program that I did, and I learned a lot. But at the same time, I see a lot of things that they don't really portray to people how they should. First of all, if you're paying $12,000 or $20,000 for education, it makes you curious on how they're really trying to get you to succeed when you'll be paying $12,000 to $25,000 back in debt, unless you took that out of your savings account or you took a loan out against it or something like that. So it makes me curious to know how they really want you to succeed if you're taking all this debt on just to be able to participate in the class. And then they were like, hey, we need you to have about $10,000 to start investing, after we get off the paper accounts. And I'm like, okay, 12 grand or 10 grand. I mean, it's a lot of money. It's like, okay, well, I just paid this for that class. So I could have used that 12 grand. Why not do a smaller payment, and if you're going to help me make so much money so quickly, so to speak, and teach me all these magnificent ways to make the money, why am I, investing so much in just this training and I don't have anything left to invest, and now I got to pay this debt off, that I just created. So it's kind of like a catch-22. So are you really teaching me enough to make me beneficial in the future? Maybe. If I have a crap ton of money I'm just willing to throw around like that, and to me, 25 grand, that's a lot of money. For a lot of people, that's way too much money to pay for something that is, maybe you'll make some money, maybe you'll succeed. Now, if you know what you're doing, you can absolutely make that much money back. And I'm going to use my Robinhood account as an example. I took all the money out of it last year, and I started back with $20. All right, every 2 weeks, I put about 50 or 60 bucks in from a paycheck. And I did that consecutively up till about $400. I made a really nice trade, swing trading a penny stock. I ended up making $400 profit on it, so now I'm up to $800. And then I did a few more trades, and then I was like, you know what, let me hit these options pretty heavy. And I went over to hard on the options instead of a few here and there, and I turned that 800, now it's about 1600 on average for the last week. So I got up over 1730-ish, and then now it's back down to like 1660. And you can't take these days for losses, because chances are they're not really losses. So as I said in some of my other videos, which we'll talk about in a second, is the expiration time. So let's get right to that. Anyway, real quick, like I was saying, my arm's getting tired of holding this thing already. Sorry, I need to work out more. So let's talk about options. Please don't overpay for training that may or may not work. If you're going to pay that much money for something, be 100% invested in it, more than 100%, so you can actually benefit and learn from the money that you spent. Because spending that much money on something is just ridiculous if you're not going to put 100% into it. Okay, let's learn the basics of options real quick. Okay, and an option is basically a contract similar to what it is. Let me see if I can flip this over. Hold on. Let's see. There we go. All right. Sorry, I had to look at my chin there. There we go. Give that arm a break. So, basics of options. You can find these in my books on Amazon. The Fisher Trader website, has links to it. Facebook page, etc., etc. I have a personal Andy Nash page for the Fisher Trader. It's got a red bull and a green bull and a red bear for the bulls and the bears as the icon page right now. So, option. What is an option? An option is a contract between a buyer and seller that is matched by either a brokerage or a clearinghouse for options. What does that mean? That means that, say, Google stock is $1,000, and this guy wants to sell me the contract for, $1,020. It doesn't sound like a lot, but in something that big it is. So the option price per se would be $200, right? So it's going to show $2, okay, but it's also going to be times 100 as your multiplier, because option contracts are 100 shares of leverage. So with that being said, that $2 is actually $200, okay? So I don't want to pay $200. Let's say I want to put a limit order. I think the stock price is going to dip a little bit this week or next week, and I want to put a limit order in for $180. So $1.80 on the option price, actually $180. So I'm already going to get in $20 lower. That's what you call a limit order. Don't just buy the market order right off the bat unless you have a very heavy feeling that thing's about to jump up, because if it doesn't, it might go the opposite direction, at least 10, 20, 30%. And if you're not patient, you will sell that by fear and you'll lose your money. And then just to see, oh man, 2 weeks from now it just blew up and I could have made more, and you got out of the position altogether. Now it's hard to get back into the position because it's going to be probably $240 for the premium because of implied volatility. So that's IV if you didn't know. Now, that's the basics. Options are very simple. I'm actually left-handed, so if this looks weird, I'm sorry. Options are very simple, okay? Don't let people tell you that, oh man, you're going to lose all your money because you're trading options because they're so complicated. I can't understand it. I get told that a lot when I talk to people about options. Well, how are you building this account up so fast? Are you trading penny stocks? Are you trading, blue chip stocks? What are you trading? I'm trading options on blue chip stocks because let me tell you this. Zynga, for instance, nothing against their company. I bought some option contracts at a great price. The premium went through the roof and I missed it. Okay, no big deal. I had a really long expiration on it. It was like 4.5 months. So what I thought about it was, okay, let me leave this here and I'll wait. I put a limit order. The price actually shot back up to $70. So $70, I only paid $25 for it. I had 3 of them. And instead of being able to unload them at 70, the volatility was there, but the transactions weren't really happening. So the liquidity is what I'm trying to say was actually hard to handle, because had I been able to sell it at 70, I would have had 180% return times 3. So that's a pretty nice return. The buy-in was pretty cheap. It was like 36 for one, 26 for the other, and I think 24 for the other. Because like I said, it trickled down, and all of a sudden it shot back up out of nowhere when Zynga's price moved. And that's the comparison between options and stocks, is that whatever option you're trading that stock with, the stock price affects the option price, right? So cannabis is huge right now. I'm making a decent amount of money on cannabis on returns. And those are my biggest returns so far. Crone, ACB, Aurora Cannabis, Afria, Tilray, a lot of these big cannabis companies, Cannabis Growth Company. And I haven't traded MJ Harvest in a while. That's an indice, not an indice, I'm sorry. It's a fund, an ETF fund. And I'll likely, trade options on that pretty soon here. But I want to wait and see what the little stocks are doing because I know the makeup of that fund, so I want to see where they're at, right? And forgive me for looking tired. I need a haircut too, so don't judge me. So, options. Simple. They're very simple. They're not complicated as everybody wants to make them seem. As I just explained to you, it's basically an agreement between a buyer and a seller, which guess what? Stocks are too. So, when the stock prices say the bid is, 50 cent and let's just keep it simple. Bid's 50 cent and the ask is 75 or 95 cent. That's a big spread, but chances are you can get your order picked up anywhere in there. Say you don't want to pay 50, you want to pay 40. Well, as soon as that price fluctuates, you'll probably get your order picked up. So anyway, back to this. One thing you have to have in options, just as you have to have in stock trading in general, patience. So this has been a hard one for me overall in my last 4 years of trading. And the last 2 years has really affected me big time and to get me to kind of really churn back on my ability to be patient because I needed to be more patient in some transactions because I ended up missing out, doubling my money on one transaction that would have made me roughly $10,000 profit. But I sold way too early for being impatient. The price literally doubled my position and it would have been a very, very nice return. But I was impatient. So, with that being said, options work the same. If you're impatient, you're going to lose money, which all these other people that are talking about, that's why they're losing money. Okay? So, next thing here. People make it overcomplicated. Again, it's simple. It's not that difficult. The main stipulations of options trading are very simple. They want you to have, when you fill it, you have to apply for options, and you have to apply for a margin account depending on what platform you're on. Robinhood is just the options account. You don't have to apply for margin until you have, well, you never have to apply for it, but you can apply for margin over $2,000 in your account. So say you got $5,000, you can pop $5,000 in there in the Robinhood account. Free stock when you sign up, especially if you use my link. Yes, I do get a free stock too, if I'm not trying to pull anything over your head. And you can get a stock anywhere from $3 to, I guess, $1,000 if Google or something in there. So, with that being said, margin is basically your ability to use whatever percentage that brokerage is willing to lend you. So basically, you're borrowing money from them. But if it's all profit, you're just handing their money back, and you made even more profit than what you would have originally. In margin, on Robinhood, your $2,000 must stay $2,000. In the event it goes under $2,000 or your position loses a certain amount of money that looks to affect your margin account, you will have to put back and hold in at least that $2,000 amount. So that always has to be readily available. I don't know if it's $2,000 cash. I haven't even opened margin on there. I haven't needed it. Now, once I get my accounts about $3,000 or $4,000 organically from trading these options and making those profit returns, like I said, I want to average 30% for every transaction. If I can't, I want at least 10. And if I can't do that, at minimum break even. I do not like to lose anything, but that is why we're down here. Expiration. We want our expirations to be long enough to where if the stock jumps way up or way down, away from our position we have, say it's a call, you want the price to go up. Put, you want the price to go down, okay? So if you open a put, you bought a put on something, that means you think the price is going to go down. Your price premium is going to be, if the stock's already heading down, your premium is going to be higher to pay. But if you're already in it and the stock's going down, the premium goes up, and that's how you make money. Sorry, my little raggedy right-hand writing over here. Calls. So you want the call to go up. You want the price to go up. That's a call. Say you bought a call and you want it to go up. Say it's at, I always like to get in the money on options. So say right now, I feel like the price is going to get some heavy volatility. Price is going to jump. Even if it only moves half $1 or $2, in that range, say it's at $8 and I buy, an $8 call, the price is already there. So I'm already at the money, in the money. And depending on where the price is actually exactly at, and say this jumps up like I did at the Crone. I bought a $9 call. The price was at $8.98. The price turned around and jumped to $14. I sold both positions for $300 each, which was 100% profit on each, which made me a grand total profit of $300 on that trade. One trade, 3 days worth, $300. Was that hard? No. Anyway, so let's get back over here. Calls, this is your basics of options, okay? Now, if you want to get into a little more detail, we can do that too. But it's very simple. This is not complicated. All right, I'm 30 years old. There's some other traders out there way younger than me. My kids are going to know this when they're 15, okay? One's 5 and the other one's 1, so we got a long way to go for that. But volatility, as we were kind of speaking about a while ago, volatility heavily affects your prices here, okay, between calls and puts. So volatility means that not the volume, the volatility. So the volatility, is going to be where, some implied volatility would be the cannabis sector is going to fully legalize in the U.S., and it's going to go crazy. People are going to start buying up cannabis left and right, stock-wise, just to see that they can make some money on it, whether short-term or long-term. And that's the difference between traders and investors. Investors generally go long-term. Even on options, you can actually buy options contracts a year on, and I've seen some 2 to maybe 3 years out, depending on how far, but mostly 2 years. So right now I could buy a position in 2020, and see what's happening there. It all depends on which option it is for which stock. Stocks that have been around for a really long time, no problem. You can buy something 2 or 3 years out. Stocks that have been around for, like Chrome, for instance, it's been around for a minute, but not really. So the latest I can buy is like 2020, I think it's January. But the premium is super high. But the thing is, you don't really know how cannabis is going to be affected in America. Now Canada fully legalized back in October. That was great. Huge step forward. That's when Tilray hit volatility, implied mainly, because the stock price went from 50 to 100 to 150 to 200 to $300 in about a week. Okay, that's ridiculous. So people that had those options, that bought way options up here, cheap premiums for, say, $60 or $30 or $90, and it turned around and went, blew past that price, that premium just turned into $900, or something crazy like that. And wherever the price is out on a large cap stock, or a stock that's heavily, heavily traded with implied volatility, the price is going to be reflected there, and you're going to notice that. If the current price of Chrome is shooting up from 12 to 13, right now it's at 13 and change, say the current price is at 240, you can look at the implied volatility on that stock, and it's going to show you a percentage on that option contract. But you also want to see open interest and volume. If the open interest is like 100, you're not really going to want to get that unless it's way, way far out there and something everybody else doesn't, because if there's no open interest on it, that means the liquidity is going to be very low. So if there's a lot of open interest, not really any volume, that's not so bad, because the volume may come later. The farther you go out on the option, the less open interest you might see, and also the less volume you'll see. Now, if you see a ton of open interest, that means people have a generic understanding of the market in general that likely those prices are going to be, either reached or highly affected upon downstream in the long term. So with that being said, that's kind of sort of how volatility affects. Now, we covered patience. Simple. Don't overcomplicate the trading. It's not very hard. I've lost more money trading penny stocks and trading stocks in general than I have options ever. All right, and we're talking about 4.5 years of trading wise. Heavy in options in the last 2 years, and I've barely lost any money compared to trading stocks. Trading stocks alone, easily lost $5,000 or $10,000. Trading options, maybe lost $200, $300, maybe in that last 2 year mark. And like I said, I got heavy in on the last 2 years. I wasn't trading them as frequently as I am now, but it's been a huge noticeable increase in my account. Overall, organically gaining. I haven't really deposited any money in the Robinhood account now. So you're talking about $20 roughly 5.5, 6 months ago, up to about $1,700 now, and give or take, $50 there, because it keeps kind of fluctuating on some prices, some options I have. So it's okay. So this is kind of a basic, class for anybody that doesn't understand or wants to understand. Now, if you want to learn more, again, I have 2 books out on Amazon. Both are fairly short, 40-something pages on one and 20-something pages on the other, but they get right to the point. And they kind of explain a lot of things that people say, oh, well, this and this, and I give some examples and some explanations that I had of experiences I had in those books, right? I also talk about Nadex binary options. Nadex binary options are pretty great. They have something now called touch brackets. I haven't played with that yet. I might throw $100 in there soon just to see how they work. Supposedly, if your market's hit, you'll make profit. You automatically take that set profit that you've had in there. And with that being said, I need to get a tripod now. With that being said, Nadex can be good for a lot of people. Now, Nadex options are literally binary, 0 to 1, yes, no. You either hit it or you don't. All right, and I think with the touch brackets, they're getting a little closer to real options, because in a real option, my number one rule, never, I shouldn't even say this. I shouldn't even say it. I'll say it anyway. I don't care. So, my number one rule is to never, ever hold an option until expiration. I have lost money that way, and if you hold an option till expiration, the chances are you can't get rid of it now, and then that's the reason you're holding it. The only thing I have is Trevena, which was their FDA approval got shot down. It's a biotech company. Their FDA approval got shut down, and the price went from $3.60-something, and it's at like 50 cents now. Thank God I only bought 2 options contracts on it. And I got them cheap. I only paid $5 for each, so I'm only down like $4, so it's not a big deal at all. But those 2 contracts, I got to limit myself for like $10 or $20 or something. And they don't expire out until March. So I still had plenty of time, and I bought them back in December. So, where are we at? Don't overcomplicate your trading. Options are simple. Don't make it harder than it is. Call, price is going up. Put, price going down. All right? Now, what if you could combine these, right? What if you could make them one? What if you could play both sides of the fence? I talk heavy in this on my second book, The Fish Hook Trader. It's the one with the, I got a copy around here somewhere. It's the one with the dollar bills faces on it. That'll be the one that you want to really read first, in my opinion. The second one is, I think I'll blend them together later on and make it one big book, and then maybe eliminate the other 2, or just sell the bigger one at a decent price. So if we can combine these right here, I want to buy a call and I want to buy a put, because I don't know if the price is going to go up or down, but I know that if it moves a certain direction, like Ford stock, for example, I can pretty much predict which way Ford's going every time I see it go heavily down or heavily up. It has the same descending triangle pattern for the last, year and a half, and all of the charts, they look the same. They have a nice high, and then all of a sudden they go down. They come up a little, and they go down some more, and then they go way back and down again. So, I've efficiently made money off Ford options consecutively this entire year. Now, how do you combine these? Strangle. This is an option strategy. My favorite option strategy. All right. How do you not make money on this? We'll get that out of the way. You don't make money on a strangle if you bought at a price where the price just stays the same. So say you bought prices at $8.50. Say you bought a call at $9 and you bought an option of a put option on that same strangle for $8. So price is at $8.50. All right, let me switch back here because I don't write right-handed. I'm one of those special people. Let's see. So $8.50 is current price. We buy a call at $9 and a put at $8. So that's where we are. And one of these, we want to be either above here or below here. All right, and whatever premium you pay, so say it's $1.50, they'll actually subtract that from here and then add it here. So your actual break even would be $10 on top and $6 on the bottom. All right, so with that being said, $7 on the bottom, I'm sorry. 10 on top, 7 on the bottom. Am I in that right? Hold on. Yes, sorry. Holy macaroni. No. Sorry, guys. Sorry. I was looking at the wrong number. Your break even is technically $10.50. Another reason I don't run to expiration. And then 8 minus your $1.50 there. So you're looking at $7.50 at 1. So $6.50 is your break even there. All right. So here's the thing. Why do you want to wait to see if the price goes way down here or way up here? Now, in theory, if it breaches this and it goes past the expiration and the price is above 10.50, but if this is your break even, look how much the price has to move for you to actually make a return on that that's anywhere decent. Now, if the price is at 10.25 and you paid, $1.50 for it, chances are if the price jumps up in the next month or so, to say 10.25 or 10.45, you're getting really close to hitting this premium, this mark or strike price, if you want to call it. And if you only paid $1.50, chances are that could be $2.25 now. All right, so that's a whole $75 that you just picked up just for the price moving to here. Well, I don't know about you, but $75 on $150 buy-in is actually a really great return, and I would likely close this position. Done. You just made a nice return. So, with that being said, your rule should be 30% cash out or close, whatever you want to call it. All right, this is my rule. If I breach 30% and I don't think it's going to keep going or make some ridiculous move on the price, I'm going with 30%. If I see it going backwards after it reaches a certain 30%, I'm going to come over here and at 10% minimum, I'm closing this position. I want to keep my profit. Well, wait, you said earlier if I just hold on to it longer, maybe it'll go back up. Yeah, maybe it will. But guess what? The longer you have your money tied up in a contract, the less money you have working for you. So if I can take 30% here and go turn around and put that profit along with, whatever other option I decide to buy over here, now I have both sides working for me at the same time. And with that being said, that's something that you want. I actually used to be really, really good at math. I could do that stuff without even thinking about it. But I had to think of the order of which I needed to subtract on that put, for the break even to actually be correct. So, here we are. Blank board. Sip some orange juice. Delicious. Disregard the house. I'm over here trying to guess what book I wrote when I have them right here. So here's the one. If you don't know about the Facebook page, I'll put the link below the video here. This is the book, The Fish Hook Trader, General Investing and Options Secrets, Rules to Trade By. And that's me on the back. That's how you know it's me. Sorry, it's super blurry. I'm actually giving away one of these books. I just did the new Facebook page. It is called Andy Nash. I tried to do a name change to Fish Hook Trader. Stupid Facebook rules are like, you're changing the idea of the page or some crap, so I couldn't do that. So if you want my honest opinion, it's in here, okay? I'm being pretty straightforward with everybody right now. I'm not trying to steal your money. I'm not trying to feed you any bull crap. I'm not trying to sell you on anything, so to speak. I'm trying to help you. The fact that we don't learn anything about this in school, even economics, you learn how to double a penny a day and you have $1 million in 30 days, but who in the blue hell can double a penny every single day once you get into the thousands, okay? So you're doubling those pennies too. So here's the thing. Why not return something that you can actually make money on, that you can actually actively invest if you want? But you know what the beauty of options is? You get back something that is the most important thing in life that we all forget. Because we're so used to doing it. We're so used to running 9 to 5, 6 to 3. I don't know. What hours do I work? I work from flipping 7 to 7, Sometimes, don't be a creeper. If you try to come to my house when I'm not home, I have tons of alarm systems. So anyway, you're working, 8 hours, 12 hours, whatever your schedule is, man, you're just losing time, especially if you have a family. That's even worse. For me, trading stocks and flipping penny stocks and swing trading and all this stuff, to me, my wife's telling me all the time, she's like, hey, why don't you be present? And I'm like, wow, that's a really hurtful thing to say. But it's true. I was watching the freaking stocks so much that it was hard for me to really focus on anything else. Of course we played, and I still was a dad, and I'm not stupid. I didn't just blatantly ignore my family. But there are some people that do that because they're like obsessed with this factor of, I don't have time, I gotta watch it, because the market will stay open from, depending on your brokerage, they open at 7:30 and they might not close until 8 p.m. Okay, Fidelity stops at 8 p.m. after hours. The market itself closes at 4. Okay, depending on what state you live in, obviously they go to do time change. But in Georgia here, the stock market closes at 4 o'clock and opens at 9:30. After hours goes to 6 on Robinhood, Fidelity 8 o'clock. So I can really play both sides if I want to. Now the coolest thing is, get back some time. I noticed with these options contracts, I set up expirations that are at least 4 months. Why? Why do you set it so long? Like I said, you want your money to work for you. Okay? Money, work for me. Yes, I abbreviated because I didn't have space. I want my money to work for me. Okay? So if I cash out this option in, say, 1 week, guess what I can do? If I made profit on this and the price goes back down, 2 weeks later, I can rebuy that same position. All right? I can rebuy that same position using the profit I made here. And I still, my expiration originality was 4 months. I've already rebought the same contracts like 7 times. And still, I let it drop. And once it dropped, I rebought it. And then it went back up. And I cashed out again. I do not cash out anything. And I say cash out. I'm not taking the money out of the account. That means I closed the account. So I should say I closed the position. So I closed the position and took my profits. Okay. Closed the position, excuse me. Closed the position. As soon as I hit this mark here, regardless, 37%. That's the magic number. Warren Buffett's a billionaire, freaking 80 or 50 billion dollars or whatever. But his rule was he wanted a return of like 36 point something percent, 37. I'm rounding up. So if you can average a return like a billionaire, chances are, no, you're not going to become a billionaire overnight, unless you just got a crap ton of money with, that you're investing with and making all these kind of, crazy returns. So 37% automatic close position. I don't play with it. I don't care if it goes. Now, if it went to 150% return and I cashed out at 37, of course, I'll feel sour about that for a minute. But then I remember, wait a minute, that's guaranteed money. All right. So like I say, do you want a chance to have $1 million in the future, or do you want $1 million now? Well, that's a 50-50, because chances are this return can get you to $1 million, 1 mil, eventually. But if you're going for 115% return, which sounds ridiculous to some people, but I've seen it so many times trading options, it's unreal. You buy a contract for $50, the premium goes up, implied volatility hits, tons of open interest on it, tons of people pouring into the options, going in the same direction you've already bought. Guess what? That 115% right there can be very, very simple to make, okay? And again, don't overcomplicate the trading. Now, why do you close at 37%? Well, one, I just talked about that being a billionaire with Warren Buffett, and that's what he did. So you copy, millionaires, billionaires, chances are you're going to get some similar results, no? But what else? Okay, so 37%, that's the return you want. And now automatically close at that. Well, what if it's, 3 months in and it's losing money and it's down $25, $30? Okay, well, how much percentage is that? So if you're at 5 or 10% loss and you faithfully see that it's going nowhere, just close the position. Take your money, put it in something different. Okay, it's not very difficult. You know how much money I lost on stocks trading one stock? Because guess what? If that stock doesn't go up, you don't make money. You lose money. If it stays the same, okay, great. You didn't lose anything. But you lost a trade fee, except for on Robinhood or Webull, and a couple other ones are doing trade free now that I'm aware of, that TD Ameritrade or something, trade fee free 24 hours on certain stocks or indices or funds or whatever. But actively, Robinhood is trade fee free, okay? So that's why you're able to benefit so many profits. Now, if you trade consistently and very constantly, the more trades you make, the more fees you're going to get charged, okay? that's another reason I love this. So if you're trading options on a brokerage that's charging you $5 or $4.95 or $6.95 per transaction, you're already negative $14 right off the bat. Okay, why would you do that? Or 10 depending on what brokerage it is. But if you're going to go negative that, you have to subtract that from the profit that you need to make to meet your goal, and then you're looking at it's useless. I still trade on Fidelity, don't get me wrong, but I prefer Robinhood just because it's a lot easier for the user and it's very quick in the hand, right? I don't have to go in here, select this and this and this. I just go boom, boom, close, buy, open, whatever. It's very quick. Speaking of options real quick, on Robinhood, there are minimums that you have to meet regardless on every brokerage. Robinhood's is very simple compared to like Fidelity where you have to apply for margin and options at the same time. And with that being said, depending on the level that you get approved for, so to speak, based on your experience, your net worth, and all that good stuff, you can say that like for me, I got more than 3 years experience. That's all you need on Robinhood. So 3 years of trading experience, period. And, and they want to know, are you advanced, intermediate, amateur, whatever. But in order to get approved for options, you need to be approved for at least, the basics, which is should be intermediate. If you do 3 years or more and you consider yourself a intermediate or advanced trader, then you're not going to have a problem. To me, I'm advanced because I'm trading a lot of different types of options. As you saw, my favorite was the strangle. Very, very simple. This stuff is not hard. It's really not. It's kind of crazy. So 37%, that's what we're going for, right? Close it automatically. I'm actually going to rewrite that. So you want time on your side. Okay, let's talk about time real quick in options. Time in options is time equals the Greek theta. Primary lesson right here. Again, we said we want this for months. Now, here's the thing, and I disagree with some folks on this. And, some of them had their way of teaching, and I have my way of learning. So you want time on your side, right? So on a call, the premium, the more time you have, the premium will eventually decay, but overall the premium will stay up. Now on premium for your option, you're going to make money on this 1 month expiration. This is going to be a put. All right. The premium cost is actually going to rise in order to open this position. Okay. And the same thing as far as 4 months go for the premium for the call. So time is going to work against a call almost always. Now with a put, you actually want time on your side because time theoretically is on your side because you're doing a put. You want the price to go down. If the price drops the next week, 40%, and your option just goes through the roof, this premium is going to rocket, okay? This premium is going to rocket if the price goes way through the roof and the expiration's coming, but not quite there yet. So at this rate, when you have a month left out of this 4, and you're at this mark now, going into the 1 month left, your premium is going to get eaten away, right? So this is slowly going to start going away. Now you have a little bit left. Whereas this premium on this 1 month for a put is actually probably going to get bigger. You're eating off the other side, so the premium is going to actually get more expensive. I had this backwards. The premium is going to get more expensive. All right. Here, the premium is up in this first half, but when you only got about a month left or 20% left, what do you want to say?